Hello everybody and welcome to our discussion of the sole community hospital and Medicare Dependent Hospital, hospital-specific payments. In this video we are going to talk about the hospital-specific payments themselves, a little bit of background. We'll talk about updating the target or base rate to the current year. We'll go through a comparison of interim payment and claim calculations versus final settlement. And then we'll talk about the final reconciliation, which is the allowable payment calculation. We'll see how those update factors get applied to get you to the year in question on your cost report. Now, I do want to mention this particular video pairs up well with the sole community hospital, Medicare Dependent Hospital base rate calculation video that we also have out there. In this video, we're talking about how to use those base rates to calculate your current year hospital-specific payment. So the background here is that a provider that is a sole community or Medicare-dependent hospital is always paid the higher of their normal federal rate, which would be your DRGs plus your DISH plus a few other federal items, or the applicable updated hospital-specific target rate for that period. Now, when I say the higher of those two, for a sole community hospital, that is true. It's the whichever one is higher. For a Medicare dependent hospital, it's actually the federal rate plus 75% of any excess difference if the hospital specific rate is higher. The key thing here is that being a sole community or Medicare dependent hospital will never hurt the operating payment, and it'll only increase it or leave it at the same. So as we talked about in the other video, both federal and hospital-specific rates are per discharge, and they're based on something known as the DRG weight from the PSNR. We'll see where that comes into play in this next slide. But as we talked about in the other video, this is a claim-specific case mix index for that one discharge. If you take a look at PSNR report type 110, here we have a period of time. So notice we have split this at 9:30, so 10-1, there's a split for those. So this is a group of claims for each of these columns. Now we have a DRG or CMG weight, in this case 712, and then the other one is 721. Again, that represented a number of discharges. This first column is 533 discharges that generated 712 worth of DRG weight. So what that means is on average, each of the DRGs were more than 1.0. And you can see something similar in the second column. But the point here is that if you take a look at that DRG weight, which we're going to use for our calculation, but if you take that weight divided by the discharges, that gives you a case mix index of a little over 1.0, so it's 1.3. And again, from the last video, the case mix index is just a representation of how complex the average case for this provider was, the average service, if you will. The payment mechanism, again, for a sole community hospital, it's the higher of the two. So another way of saying that is it's your federal rate plus 100% of the difference between the hospital-specific and federal rate. Again, only assuming the hospital-specific payment is higher. But for Medicare Dependent Hospital, it's the federal rate plus just 75% of the difference between a higher hospital-specific rate and the federal rate. We talked about the base rates, also known as the target rates. We talked about these in the other video, but as I also mentioned, we don't just take that base rate. For example, we don't take a 1982 base rate and try to use that to pay claims from 2022. That would obviously make no sense. Those are very outdated costs. So the rates are updated each year to account for inflation based on all the market basket updates, any budget neutrality factors, a variety of different adjustments. They're updated every year so that we'd have the 1982 rate potentially inflated forward to 2022, and that would be used to calculate payments for 2022. Now, one way this could have been handled is that CMS could have required MACs to adjust that provider-specific file, which adjusts the pricer we could adjust it with a brand new base rate every single year effective at 10/1. However, CMS did not go that route. Instead, they have certain intervals at which those rates are being updated or inflated, and in some cases rebased to a brand new cost report altogether. They're updated at certain intervals, and then Pricer knows what factors need to be added on top of that to get to the current year in question. And we'll see some examples of that in just a bit. The general, not so much a rule, but the general practice has been that the Pricer is updated at least every 6 years, and usually a little bit more frequently than that. So the system was kind of built to remember about 6 years worth of update factors. It's not a hard line, but that's generally what's happened in practice. Now again, I said some cost report periods are rebased. So we have the 1982, 1987 rates. Those are the original rates. But there have been a few different rebases since then, which means we're using brand new cost reporting data as opposed to just inflating it with an update factor. So the 96, the 2002, and the 2006 years, depending on whether it's sole community or Medicare dependent, those were actual rebases. Every other update that we have is just an inflation adjustment. Now, we talked about this in the other video, but I have some notes on that as well here. So the updates to the provider-specific file or to Pricer were made at these different intervals. 1983 would have been the first rate. 10/1/1990, that's either a rebase or an inflation, depending on whether they rebased or not. 10/1/94 was just an inflation to get to that point. 10/1/2000 was either an inflation or some sole community hospitals rebased to 1996. The next round, there was a phase-in to this 96 rate, so that's why changes were made here. At 10/1/06, this was either an inflation or a rebase to 2002 for certain Medicare Dependent Hospitals. There was another inflation for the first fiscal year beginning on or after 1/1/09. That was for sole community hospitals. And then 10/1/12, there was an inflation to $2,012. And then the final update so far is 10/1/18, and the rates were inflated forward to 2018. And again, FIS, or the Pricer, will update from fiscal year 2018 and on. Now, eventually, there will be another inflation, maybe even a rebase, depending on how Congress and CMS decide to go about it. I would expect this to come sometime in the next couple of years, because that'll put us right at the 6-year mark. We're about at the 5-year mark right now, 4.5 year, depending on how you look at it. So those are the updates, and again, the rate keeps getting inflated forward so that it's reasonable to use that to actually calculate a current year payment. Now, when you take a look at the internal claim calculations, or if you just take a look at the interim payment calculation, if you will, Pricer automatically updates that rate that's entered, that rate that's in the system. It updates it to the current year in question. Then that updated rate is going to be multiplied by the DRG weight for that one claim. Now you have the hospital-specific payment for that claim, and that is compared to the federal payment, which includes the DRG payment, any outliers, DISH, indirect medical education, IME, but notice it does not include GME. That's separate altogether. That's after all of this. So it compares these two payments to see which one's higher. If the federal payment is higher, that's just the one that's going to be used. If the hospital-specific payment is higher, then again we have that comparison, where we have that for sole community hospital, they take the highest of the two. For Medicare Dependent Hospital, it just gets 75% of that extra amount. Now, on the cost report, we're talking about all the claims that have happened throughout that cost reporting period, all the discharges, but it's basically an accumulation or an aggregation of all of those individual claim comparisons. Now we're adding it to the cost report. So again, this is final reconciliation. This is what the auditor will do at that point. So now we'll move forward to discuss the final reconciliation on the cost report. Now these steps are what the auditor will do at that time to recalculate the hospital-specific payment and report it on the cost report. So they will open up the system that we refer to as FIS, which basically gives you the same information you'll find on the pricer. They take that hospital-specific rate or that base rate, that target rate. Keep in mind it's been updated over time to get to one of those stopping points that I described a few slides ago. Then they will take the PSNR, they will order a PSNR for that period and enter the DRG weights that we discussed. Now here's the important thing to note. All of the update factors correspond to federal fiscal years. So if this is a federal fiscal year cost report, then it's a pretty straightforward calculation. You just need one PSNR generally. But if it's anything that spans 9/30 or 10/1, then we have to split the PSNR at 10/1, and we need the DRG weight from prior to 10/1 and the DRG weight for 10/1 and after for those claims. And we'll have to do a separate calculation. And on E-Part A, there are two separate columns that would need to be used at that point. We're going to see an example of this form and how this calculates all the updates. But this amount would be reported on E-Part A, line 48. And as we'll see, it's compared to line 47 to see which one's higher. Now, if you have an E-Part A Exhibit 4 or Exhibit 5 for the low volume or the hack reduction, those also require the same calculation to be done. And step 3 is to ensure that the proper S-2 control questions are answered. Basically, they ask, are you a sole community hospital? Are you a Medicare Dependent Hospital? And how many periods throughout the year were you each of those types? In other words, did you start out as a regular acute and then get sole community hospital status midway through the year? Or did you lose it midway through the year? That would require different columns on the cost report. So when we see the work papers in just a bit, there's generally one lump sum we'll talk about because we're bringing everything together in one column for the comparison. So line 48, this hospital-specific payment, this includes everything from the calculation that we do internally as auditors. It includes both splits, everything, and it's compared with line 47. If it's a sole community hospital, the higher of the two goes to line 49. If it's a Medicare Dependent Hospital, the calculation is line 47 plus 75% of any excessive hospital-specific payments. Low volume, again, just a quick word on that. It's the same idea. This gets reported in line 14, but we still need, in fact, it brings it over from E-Part A. You'll see that right here. Line 14, hospital-specific payments, they are split here. They do need to be split for E-Part A Exhibit 4. Now, the forms that we use internally, we'll walk through an example in a bit, but they tell the auditors what splits they need to order. And there's always going to be a 10-1 split, but occasionally, historically, there have been other mid-year splits if CMS has some sort of change mid-year. So they have to do at least prior to and after 9/30. Then we have to take a look at whether that provider had a CBSA hospital quality indicator. In other words, did they fail to submit the quality data that they needed to? And was there an EHR reduction indicator? In other words, they failed to attest meaningful use. Those two things impact the update factors that are used. Then they will go in and they will grab the target amount, which is, again, the updated hospital-specific rate. And by updated, I mean updated to that most recent federal fiscal year that CMS instructed us to. So they'll grab that, and then our calculation knows that, hey, if this is 9/30/13 and this rate would have been updated to a certain point, the 2012 actually in this case, it knows 10/1/2012 is the last update. It knows that it needs to apply this 1 year of update factors to get it to 7/1/13 through 9/30/13. So you'll see here, I know that's kind of hidden, but you'll see an update factor. 1 year, you'll see a budget neutrality factor. And you'll see there was a documentation and coding adjustment that applied that year. You'll have an updated target amount for this period. Now, if we take a look at the next year, we're past that federal fiscal year. Now we need to apply one more update factor and one more budget neutrality factor. And there was another update there, a policy on admission factor that came into play. So we had to apply that as well. But the point is you have an updated target amount. Now that's not the amount we're using. That's just one discharge. That's the hospital-specific payment for one discharge. Notice down beneath it, we have the DRG weight from the PSNR that we need to get. Here again is where that DRG weight comes from. The PSNR report type 110. We have to have the proper splits before and after 10/1. Now notice it is the DRG weight, not the DRG weight fraction. The DRG weight fraction is transfer adjusted. We need to use the raw DRG weight. We plug the DRG weight into our calculation, and that gives us the total hospital-specific payments for each split. The sum of those two amounts is what goes to E Part A, line 48. And that would be entered here. And again, depending on whether it was a sole community or Medicare Dependent Hospital, we'd have to do a comparison and recalculate to get line 49. If it's sole community, which in this case it must have been, line 48 just carries down to line 49. That takes us through the discussion of the hospital-specific payment mechanism. Hopefully this has helped to clarify some of the issues you may have had. But I thank you for your time, and I look forward to seeing you in our next video. Have a great day.